Our classroom stock portfolio of high-yield, dividend-paying companies now has an annual return of 28.81%, and it's beating the S&P 500 since the portfolio started a year ago. And our dividend growth stock portfolio, started 2.5 years ago, has an annual return of 17.6%. It too is beating the S&P 500 since it started. On Monday, the S&P 500 fell 3%, and many investors new to investing freaked out. But down days like this are very common, as are recession. It's part of the economic cycle. Monday's down day was touched off because the Japanese stock market fell 12% overnight before the U.S. stock market opened on Monday. What happened was the Bank of Japan decided to raise interest rates unexpectedly. Now, many aggressive investors worldwide had borrowed Japanese yen at a very low interest rate and invested in the U.S. stock market. Apparently, a lot of it in the mega cap tech stocks like Nvidia, which probably helped drive up Nvidia's price. But when Japan suddenly and unexpectedly raised interest rates, those investors who were in debt got margin calls, meaning they had to quickly pay back a lot of the cash they did not have. So they indiscriminately started selling off stocks to raise that money, which helped cause the U.S. stock market to fall. So what is this slide showing? It's showing the portfolio value over time for our main portfolio, which invests almost exclusively in dividend growth stocks. In 2022, we started investing $12.50 each week into the portfolio, and it's now worth $2,216.78 after 136 weeks. Each week we take that deposit and split it up to buy 10 different dividend-paying stocks, so that's about $1.25 per stock. And in August of last year, we started a second portfolio, this time investing in high-yield dividend-paying stocks. Hi, Professor Rex here. If you're new to my channel, I teach college accounting, and I often show my students how to use the accounting concepts that I teach to pick stocks because it grabs the attention of my students and gets them engaged. To show them accounting concepts in action, starting 2.5 years ago, each Monday I invest actual real-world money, $12.50 per week, which is roughly the equivalent of $50 each month, into 10 different dividend-paying stocks. And because those original students are no longer in my class, I decided to make this video series to let them know how our portfolio is doing. Also, viewers can use our progress as inspiration for their savings goals and investing goals and get ideas of company names that they can do their own research on. There are timestamp links in the description of the video in case you want to just jump to the list of stocks we bought this week or the list of our best performers or any other section of the video. Now in 2022, the year we started the dividend growth portfolio, the market did not perform well, but because we do not believe in trying to time the market, we kept buying each week at what turned out to be great prices. Then in 2023, stocks took off. Currently, the portfolio's value is over $2,216. The return has been 17.6% per year. Last year, the portfolio's return was 28.6%, which beat the S&P 500. And in the preceding year, the portfolio once again beat the market. In this video, we talk a lot about our dividend growth portfolio and our newer high yield portfolio, which is geared more towards those nearing retirement. The table at the bottom of this slide shows a portfolio comparison when both portfolios existed. The high yield portfolio was started in August of last year, and the annualized return so far is 28.81%, which is surprisingly higher than our dividend growth portfolio, which is an annualized return of 18.1% over the same time period. I would expect that the dividend growth portfolio would have the higher return over the long run, especially since the high yield portfolio has 0 tech stocks in it so far, but time will tell. Now remember, the high yield portfolio has only existed for a little over 12 months, so its annualized return will likely jump up or down to a greater extent than our dividend growth portfolio's return. This slide shows the growth of the dividends we've received in our dividend growth stock portfolio. The graph shows the cumulative dividends we've received so far. Our dividends for the last quarter increased 51% over the previous quarter, and our dividends this last month increased 41% over the same month a year ago. So why do we only invest in dividend-paying stocks in this portfolio? The first reason we stick with dividend-paying stocks is, according to a Hartford study, over the past 50 years, dividend-paying stocks vastly outperform non-dividend-paying stocks. The total return for dividend-paying stocks has been 9.17% per year, but for non-dividend-paying stocks, average return has been much lower at 4.27%. This study is updated each year and was recently updated to include last year, so go check out the source link that I include at the bottom of this PowerPoint slide. Morningstar also recently released a report that went all the way back to 1927 and came up with the same conclusion. Dividend-paying stocks have a higher return and less volatility than non-dividend-paying stocks. Maybe more importantly, historically, dividend-paying stocks have less volatility than non-dividend-paying stocks. It's much easier to stick with a less volatile investing strategy. The more volatile a strategy is, the more likely you are to panic and sell at the wrong time. So, why are dividend-paying stocks less volatile? Because most dividend-paying companies are making a profit, which is why they have excess cash to pay back to investors. As you can see on the screen, risk and volatility of dividend-paying stocks as measured by beta and standard deviation tend to be much lower for dividend-paying stocks. And finally, the study also showed that the best performing stocks are dividend-paying stocks that increase their dividends, which is why our classroom portfolio only invests in dividend-paying stocks that have increased their dividend recently. Now, the holy grail of dividend investing is having a stock portfolio that produces two things. One, a growing stream of income that produces enough income to cover your expenses, plus extra cash to cover travel, vacations, luxury purchases, etc. And two, also produces a growing stream of income that also grows faster than the rate of inflation. And dividend-paying stocks historically increase their dividends significantly higher than the rate of inflation. This means that quality dividend-paying stocks can provide a growing income stream for a lifetime. Now, this is in contrast to bonds, which do not raise their payments to bondholders. Here are two examples of stocks growing their dividend payouts over the year. The first stock is Broadcom. I bought Broadcom, a chip maker, in 2020, just 4 years ago, for my taxable account. At the time, its yield was 5.01%, meaning for every $100 I invested in the stock, I would receive $5.01 every year. The company has quickly grown the dividend to the point where the yield, based on the original investment, is now 8.13%, and this is just 4 years later. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen so much. That's why it's important to invest early and be patient. And I fully expect Broadcom to continue to increase its dividends well into the future. And if not, that's why we have constructed a diversified portfolio. This is the power of investing in a quality dividend growth company. My second example of a high quality company with a history of raising its dividend is Home Depot. In 2003, when I was attending college, I had started a dividend stock portfolio for the investment newsletter that I had started at the time. And Home Depot was recommended for that portfolio and is still in the portfolio today. At the time, its yield was a low 0.83%, meaning for every $100 I had invested in the stock, I would receive only 83 cents. Seemingly not much to get excited about. But over the years, Home Depot has grown the dividend to the point where the yield, based on the original investment, is now 31.1%. And like Broadcom, while there are no guarantees, I fully expect Home Depot to continue to grow its dividend well into the future. Of course, investors buying the stock now are not going to get that high of a yield because the stock's price has risen. Again, this is why it's important to buy early and be patient. Now remember, stocks historically have a higher return than bonds, but are also riskier than bonds. But you certainly will not find a bond that pays anywhere close to the yields on cost that these two stocks are paying. And bonds don't increase their payouts to investors like stocks can and often do. Another reason to own dividend-paying stocks is for the potential to generate up to $123,250 of tax-free income each year if you are married and filing jointly. Remember, the ultimate goal of dividend investing is growing your portfolio to a point where it generates enough income each year to live off the dividends. And because companies historically increase their dividends above the rate of inflation, you have the ultimate income stream that not only covers your expenses but grows over time. And if you are married and filing jointly, you can make up to $123,250 in qualified dividend income and pay zero federal taxes on those dividends if you have no other income. This is perfect for retirees. If you're single, that amount is $61,625 per year. Those amounts often increase each year as the standard deduction increases and the tax brackets are adjusted. So how are these amounts calculated? First, you find the 0% tax bracket for long-term capital gain, and then you find the standard deduction, which is found in IRS Publication 505. As you can see, in 2024, the standard deduction increased, meaning that you can potentially earn even more tax-free income from qualified dividends. Then the final step is to take the 0% capital gains amount and add it to the standard deduction, which means we get a final amount of $123,250 that a married couple filing jointly could generate an income from qualified dividends that would be federally tax-free. So why did we choose to invest $12.50 per week, which is essentially the same as $25 per paycheck? Talk about that on the next slide. The main reason why we invest only $12.50 per week into the portfolio is because I wanted to show my accounting students that you don't need much to build a diversified stock portfolio. In fact, when I was making only $11,000 per year as an enlisted member of the military, I started my investing journey with only $25 per paycheck. In other words, the equivalent of $12.50 per week. And because my brokerage account, Fidelity, allows me to buy as little as $1 per stock, we can quickly and easily create a diversified stock portfolio with little money. Now, originally, I invested $25 per paycheck into the Dividend-Growth portfolio, but found this process to be so fun that I split it up and now invest $12.50 every week. And we boost the contribution once per year by the amount of inflation to replicate the fact that people's paychecks usually increase at least by the amount of inflation. By the way, I also invest in these same stocks in my retirement portfolio and my taxable brokerage account. The research we discussed in class is the same research I use for myself. Another reason I started with a low investment amount was because one day I was wondering how much a young person, in this case a 17-year-old, needed to invest per week to accumulate $1 million at retirement. And it turns out it's only $11.74 per week. Of course, since most people's annual salary increases each year by the amount of inflation at the very least, I assumed the contributions would increase by 3% each year, which is around the historical rate of inflation. That means in the second year, it's assumed that the person invested an additional 35 cents per week for a total of $12.09 per week instead of $11.74. Now, for our classroom stock portfolio, in year 2, we boosted the weekly investment 82 cents for a total of $13.32 per week because in that year, inflation was high. In year 3, inflation wasn't as high, so we boosted the weekly investment by only 49 cents for a total of $13.81 per week. Now, a very popular exchange-traded fund that only holds dividend stocks is called the Schwab U.S. Dividend Equity ETF, ticker SCHD. Now, SCHD is a large holding in my personal accounts, so I've been tracking SCHD's performance closely with our classroom stock portfolio. As of today, our classroom stock portfolio's annual return is 17.6%. If we'd instead invested the same exact amounts into SCHD on the same days, the portfolio's return would only be 8.48% per year, a difference of 9.12% per year. Our high yield portfolio is also outperforming SCHD, but by an even larger margin of 13% per year. Obviously, there's no guarantee that our portfolio will keep outperforming SCHD at such a high rate, but I've been gradually selling off my personal SCHD holdings and reinvesting in our classroom stock portfolio. I also prefer our actively managed classroom stock portfolio strategy rather than SCHD's purely algorithmic approach where no one is overseeing the stock selection. SCHD has at times had large positions in stocks that I consider to be value traps. This slide shows our best performing stocks in our Dividend-Growth stock portfolio based on when they were initially purchased. Evercore, an investment bank, remains at the top and added significantly to its total return this week by pushing its total return to 187.5% in less than 2 years. New to the list this week is Goldman Sachs with a 63.2% total return in less than a year and a half. Now, stocks in yellow have been sold. And remember that total return includes both the dividends the company has paid as well as the increase in the stock price. Now, let's turn our attention to the strategy column, specifically the category called Dividend-Growth stocks. 90% of our investments made in this portfolio were made in these stocks, which means they are high-quality stocks with a great track record of increasing their dividend payouts to investors. The other 10% of investments so far have been invested in usually smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are usually smaller companies, but studies have shown that they historically beat the market averages by a significant amount. This slide shows our best performing stocks this week. Two of our three best performing stocks this week were two under the radar dividend payers, those being Clear Secure Incorporated and Kenvue. Clear Secure was up a whopping 24% on Tuesday alone and was up 33.9% for the whole week. Eli Lilly, maker of weight loss drugs amongst other drugs, was also up double digits this week at 10.9%. Here's the usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence, which means do your own research. We don't sell stocks often, and this week was no exception as we made no sales. Now let's talk about the dividend-growth stocks we bought last Monday. Here are my ratings for the top 15 dividend-paying stocks this past week. At the request of some viewers, I expanded the list to 15. With the pullback in tech stocks, they appear to be better bargains now, as Applied Materials and Lam Research jumped back into our top 15 and landed at the first and third positions, respectively. Also, Broadcom came in at number 16, but this list only has 15, so it just missed making out this week's list. We purchased the first 10 stocks on the list that are not in the yellow highlight. The stocks in yellow have already grown to be 4% or more of the portfolio, so we did not invest more in them this week because we want our portfolio to be more diversified and less risky. Remember, each week we buy 10 stocks, and since we are investing such a small amount each week, it means we are buying fractional shares in our Fidelity brokerage account. And for those that have asked, we do not automatically reinvest dividends into the same stock from which the dividend was paid. Instead, each week when we are buying the 10 stocks as shown on this slide, we combine the weekly deposit with the dividends that have been paid that week and are sitting in the account as cash. We then take that combined total and split it amongst the 10 stocks that we are purchasing that week. In other words, we reinvest dividends weekly into the 10 stocks that we are purchasing that week. Now, for the sake of convenience, there's nothing wrong with simply turning on your broker's auto reinvest feature, but we think it's more ideal to reinvest in our top stocks each week instead of potentially reinvesting in a stock that is fairly valued as opposed to undervalued. This table on this slide shows a company's sub-industry, how undervalued they are according to our research, their risk rating, quality grade, and dividend yield. The most undervalued stocks this week appear to be Nike, ASML, and Papa John's. Remember, all these stocks pay a dividend and have recently increased their dividends, and their methodology used here indicates they are likely to continue to raise dividends. Therefore, this is a dividend growth strategy. The stocks with the highest yields are, in order, Bristol-Myers, Papa John's, and PNC Financial. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio for 90% of our purchases. The other 10% so far have been invested in smaller, under-the-radar companies that have recently started paying a dividend. These under-the-radar dividend-paying stocks tend to be riskier because they are smaller companies. But studies have shown they historically beat the market averages by a significant amount. All the stocks we bought this week qualify as high quality and are dividend growth stocks, which means they have a history of substantially raising the dividends that they pay to their shareholders. Risk is the first quality component, which we mentioned on the previous slide. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported earnings. And remember, earnings are just a fancy word for profits. And finally, the last quality component is financial health. If you're looking for lower risk stocks, I would suggest looking at American Express, Nike, Microsoft, and FactSet. Remember that the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. The companies earning the highest financial health ratings are Applied Materials, MasterCard, Visa, and Microsoft. Now let's look at the dividend growth grades of the companies. Remember, historically, the best performing stocks are those that both pay a dividend and have grown their dividend recently. As you can see under the grade called Grade for Recent Dividend Growth and Current Yield, the stocks with the best combination of dividend growth and a higher yield are Applied Materials, Bristol Myers, Lam Research, Raymond James, and PNC Financial. All of these earned an A or an A+. Ideally, you want a higher dividend, high recent dividend growth, and the best potential for future dividend growth. But that's not the way it works. Companies that are already paying out higher dividends rarely have the greatest potential for the greatest growth in those dividends. In our list, as you can see in the last grade called Dividend Growth Potential, the companies in the best position to increase their dividends substantially are Applied Materials, Bristol Myers, MasterCard, American Express, and Ameriprise. These earned an A- or better grade. The companies with the best combination of recent dividend increases and potential of future dividend increases are Applied Materials, Bristol Myers, Lam Research, MasterCard, Visa, American Express, Ameriprise, and Raymond James. On this slide, we're looking at stocks that have raised their dividends recently. The holy grail of investing in dividend-paying stocks is to have the portfolio generate enough dividends to cover your annual expenses, a level I've reached despite being on a teacher's salary. Historically, dividend-paying companies raise their dividends by 5 to 6% per year, which is above the historical rate of inflation. This means a stock portfolio can produce the ultimate passive income stream, that being one that increases each year above the rate of inflation. This week, we had Broadridge Financial announce that they will increase the dividend by 10%. The last 17 dividend increases for the portfolio have an average of 18%. This slide shows stocks in our portfolios that have chosen to split their stocks. Since we keep track of every individual purchase in Excel, it's important that we have this slide to remind us to go back and adjust the purchase price, shares held, and dividends per share that we received once the stock split has occurred. Here's a look at the 10 stocks that make up the largest portion of the dividend growth portfolio as of Sunday. Allegion is still at the top, and new to the list this week is industrial machinery company ITT. Remember, our goal is to build a conservative and diversified portfolio by limiting the amount we invest in one single company. Aggressive investors might not want to limit the investment into any one stock, but I'm a conservative investor, therefore we temporarily stop investing in a company if they make up more than 4% of our portfolio. This leads to a less risky, more diversified portfolio. It's true that our portfolio's returns would likely be higher if we always invested in our top 10 stocks, regardless of the size of the stock portfolio's allocation, but that also creates a more concentrated and more volatile portfolio, and many investors can't psychologically stick with a volatile portfolio. Volatility often causes investors to panic and sell at the worst time possible. Our portfolio holdings are at 96. That might seem like a large number of companies to keep track of, but the spreadsheet that we've developed for tracking the companies makes it obvious when to sell a company once we download company financial and accounting information into the spreadsheet, which we do at least weekly and does not take up that much time. Now let's talk about our high yield dividend paying stock portfolio. I have had several older students who are closer to retirement take my classes. They are more interested in stocks with higher dividend yields and asked to start a portfolio using a strategy featuring stocks with higher yields than the stocks in our dividend growth portfolio. So in August of last year, we started investing $12.50 each week into stocks with higher dividend payouts. The portfolio as a whole has an annualized total return of 28.81%. Since the portfolio has been in existence for a little over a year, that return will likely fluctuate a lot more than the return of our dividend growth stock portfolio, which has existed for 2.5 years. Currently, the high yield portfolio's dividend yield is 4.27%, but the companies in it likely will not grow their dividends as much as the stocks in their dividend growth stock portfolio. Therefore, this portfolio would be more geared towards investors closer to retirement. Having said that, many stocks in the portfolio have increased their dividends, pushing the portfolio's yield based on the amount that we invested to 4.87%. Now, two strategies are being implemented in this portfolio, as you'll see in the next few slides. Strategy 1 emphasizes a high dividend yield over dividend growth. Strategy 2 also features higher yielders, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds, that being high yield and high dividend growth. Strategy 2 so far is the better performer, likely because of the good performance of its utility stocks lately. Strategy 1 does not have utility stocks. The average investment in Strategy 2 has provided an annual return, a total return of 13.63%, and has been held for an average of 164 days so far, so obviously less than a year, which is an annualized return of 33% using Excel's rate function. Now, it's not likely that the portfolio can keep up an annualized return that high, since stocks historically average about 9 to 10% historically. On this slide, we're looking at the high-yield dividend-paying stocks we bought this week. One thing that's different about this higher yield strategy versus our dividend growth strategy in the previous slides is we only purchase 8 stocks each week, and we have 2 different strategies within this portfolio. Strategy 1 emphasizes a high dividend yield over dividend growth. This is perfect for investors in retirement or getting close. Strategy 2 still emphasizes high dividend yield, but places a bit more emphasis on recent dividend growth in an attempt to try to get the best of both worlds. Because there are 2 different strategies, we have 4 stocks in Strategy 1 and 4 stocks in Strategy 2, giving us 2 rankings. So each week we take $12.50 and split it between the 8 stocks. So each stock gets a 1/8 weighting. Having 2 strategies within one portfolio also means that a stock could appear in both Strategy 1 and Strategy 2, as you can see on this slide. If that's the case, instead of the stock getting a 1/8 weighting, they get 2/8, which is 1/4, which of course is equivalent to 25% of that week's investment. Both strategies still only invest in high quality stocks, meaning a quality rating of B- or better. The 4 high yield stocks we bought this week while implementing Strategy 1 are Bristol Myers, Devon Energy, PNC Financial, and Enterprise Products Partners. And the 4 high yield stocks we bought this week while implementing Strategy 2 are Bristol Myers, PNC Financial, Papa John's, and CVS Health. This week's purchases have an average yield of 5%, with Enterprise Products coming in at the highest with a 7.4% dividend yield. Here's a look at our ratings for competitive advantages, management, and financial health. And on this slide, we can see their grade for recent dividend growth and current yield, as well as recent dividend growth history. In the last column, you can see their grades for dividend growth potential, which will be much lower than the stocks in our dividend growth portfolio, which consist of stocks with usually lower yields, but a greater potential for excellent future growth in those dividend payouts. So that's it for this week. In the comments, let me know if you have any questions, or if there's any other type of investing videos you would like to see. And finally, here are the places you can reach me. YouTube, obviously, as well as X, LinkedIn, and my website, beatsthestockmarket.com. I'll see you again next weekend with a list of stocks we will have purchased on Monday. See ya!